This is Aurèle Courcelles, Vice President, Tax and Estate Planning at IG Wealth Management, and I'm your guest host for this special edition of The Living Market. I want to thank Philip Peterson and his team for allowing me this opportunity to share space in their podcast to talk to you about a topic that is often left to the last minute or, unfortunately, totally overlooked. In this episode, we deep dive into the world of year-end tax planning. My goal is to ensure that you're well prepared in the months ahead to take advantage of the many tax planning strategies that could help to reduce the amount of tax you have to pay. And today I'm joined by a special guest and colleague of mine, Sheryl Troup, Assistant Vice President, Tax and Estate Planning here at IG Wealth Management. Welcome to the podcast, Sheryl.
Thank you so much. Great to be here.
Now, according to IG Wealth Management's 2024 tax study, more than half of Canadians, and 57% to be exact, understand that tax planning shouldn't be a once-a-year scramble. They get that it's important. But here's the kicker. Very few actually make it a priority. The study conducted by Polara Strategic Insights uncovered some eye-opening stats. Only 27% of Canadians make tax planning a year-round priority. Just 1/3 feel very confident they're taking advantage of all the tax breaks available. And only 17% say they're very knowledgeable about how life events, like maybe retirement, having kids, maybe selling a home, how those things can impact their taxes. So Sheryl, let's start with the big picture. Why is year-end tax planning so critical, especially for high net worth individuals?
For sure. It's a great place to start. Unfortunately, I think for a lot of people, their version of tax planning occurs when they're starting to do their personal tax return, let's say in March or April. So they're gathering their information. Either they're going to be completing the returns or they're going to be, sending their returns to their accountant. They're looking for, what are my receipts? What are my deductions? What can I write off? And by then it's just too late. When we think about it, really RSP contributions are really the only thing we can actually sort of plan for after December 31st. So long and short of it is really, really critical to start thinking about tax and tax planning way before December so that other strategies that are also beneficial to us can also be enacted. When I think about that, I think about charitable giving. I think about tax loss selling. And then when you look at it from a high net worth individual, their life is much more complex. They have maybe multiple income sources, investment portfolios. They may be connected to trusts or corporations. And that really means that they should be considering consulting with multiple advisors, so accountants, financial planners. And so that idea of proactive planning is really going to be much more key so that they are not missing out on key planning considerations. So, in that vein, I'm really, really happy we're discussing these opportunities today.
Yeah, it seems quite all-encompassing, and it's obviously not just about saving a few bucks. It could actually be significant savings, right?
Exactly. I think a well-timed strategy could really reduce your tax bill significantly. But beyond tax savings, it's really also about aligning your financial decisions with, long-term goals, whether that's legacy planning or philanthropy or even business succession.
Great. So let's start our review of tax planning opportunities with a look at charitable giving, because you mentioned that already. It's a very popular strategy, but how can high net worth individuals really maximize that tax benefit?
Yes. So, when we think about charitable giving, it has always been a very tax efficient way to give back to your community. So when you donate cash, you receive a non-refundable tax credit, both federally and provincially. And that can help you reduce your tax bill by almost up to 50% of the donated amount. And of course, that depends on your province of residency. But a strategy that we often discuss with our clients is the idea of an in-kind donation of publicly traded securities, particularly those with, unrealized capital gains. And this strategy really allows us to essentially avoid paying tax on capital gains realized on that appreciated value, but you're still going to get a donation receipt from the charity equal to the full fair market value of that security.
So you're eliminating the tax you would have paid on the gain while still getting the credit? That seems like a really good option.
Exactly. So essentially, what the way that it works is that the Income Tax Act allows this type of donation to essentially trigger the capital gain on the security at an inclusion rate of 0%. So just to kind of, remind ourselves, capital gains naturally have a 50% inclusion rate. What I mean by that is only 50% of a capital gain that's realized upon the disposition of a security is exposed to taxation. So let's just use an example. Let's say you bought shares of a publicly traded Canadian corporation for $25,000. And now you're selling those shares and they're worth $100,000. That realizes a capital gain of $75,000. If you sold them, you would pay tax on $35,000, which represents the taxable capital gain realized. But when you donate in kind, publicly traded securities such as publicly traded corporation shares or mutual funds, that inclusion rate goes down to 0%, meaning the taxable portion of the capital gain would be zero. So in our example, rather than $35,000, it's zero. So this strategy is really going to allow you to realize no tax as a result of disposition of those securities. But now you're also going to receive a donation receipt of $100,000 from the charity. And that's going to be able to be utilized to offset other taxes payable that the individual may be having during that year.
Wow, that's definitely a powerful strategy.
It is, with anything that's always a good news story, we have to have a balanced conversation. We do have to remind ourselves that with any charitable giving strategy, it does result in overall reduction of wealth. So I just want to be clear about that. So what I mean by that is in order to recover 40 cents of tax, I need to donate $1 to charity. So as a result, my net worth has reduced by 60 cents. But for those individuals who are charitably inclined, it's a really great way to sort of essentially shift dollars away from CRA and into the hands of a beloved charity. So that's really what the key aspect is. The other thing too, for individuals who perhaps have an uneven source of income in a given year, maybe they sold their business or maybe they're reporting a large amount of income in a particular year, we often look to the use of donor-advised funds. This really allows us to sort of pre-fund future giving while locking in the tax benefits this year of donating to these types of charitable foundations. So it's a really great way to sort of donate today and realize the tax benefits today, but your gift can be, realized tomorrow and well into the future. So another great option for folks to consider.
Okay, so these types of donor advised funds, so that's my understanding of them anyways, and correct me if I'm wrong. So a donor advised fund is where I open some type of charitable foundation or an account, which allows me to get to make a larger donation now, get the donation receipt today, but decide where the money may go in the future. And in the meantime, all the money grows in a tax sheltered environment. Is that pretty well how it works?
That's exactly how it works.
Awesome. So that's something certainly that some of the listeners may want to consider, especially as you mentioned earlier, if they have years where their income may be a little larger. Now it's also my understanding that something called alternative minimum tax can impact charitable donations. Can you maybe start that by this little section here by explaining what is alternative minimum tax and then explain how it can impact donations?
Absolutely. So, I mean, alternative minimum tax is quite complicated. So we're not going to get super in depth here, but essentially what it is, it's to use its words, it's an alternative way of calculating tax for the year. And essentially what it does is it will change how certain income is calculated and or eliminate some deductions, for example. And there's philosophies as to why it's in place. But essentially, if we go back to our in-kind donation strategy that we just discussed, which again still has really great benefits, that would be a classic example that AMT may apply because for alternative minimum tax, the inclusion rate in that calculation is not zero. So essentially what happens is AMT can be triggered as a result of doing this type of strategy. So really key to work with your advisor, work with your accountant to, first of all, determine if AMT applies. It is a very complicated calculation that's dependent on all sources of income in that year. And if it does apply, what opportunities would there be to recover it? Really key thing to note is that It is an outlay in the year that it applies. You have to, it feels like a tax, but it actually can be recovered from your future taxes payable as a non-refundable tax credit. And so if you have sufficient income in the following 7 years after AMT has been triggered, generally it can be fully recovered. So ultimately, it should be hopefully a timing issue where you've outlaid in the beginning and then recovered later. But there is always risk that it becomes a permanent cost. So you always want to be cautious on that.
Yeah, it's reassuring that you can in all likelihood recover that tax over that 7 year period when you compare it to tax payable in the future. I would agree that it's probably an exception to the rule that would you would not be able to recover it. Um, let's shift gears a little bit and let's talk capital gains. And then you talked about a little bit about capital gains in the context of charitable giving, but last year in 2024, there was a lot of talk, both in the industry and even outside the tax industry, about a big change that was supposed to be coming this year. So, what's the latest on that?
Yeah, last year was fun as a tax practitioner. So essentially, let's just go back to 2024. Essentially, what was happening is Budget 2024 had a proposal where, as of June 25th, 2024, the inclusion rate was proposed to go from 50% to two-thirds. So for individuals, that would have affected them for capital gains realized over $250,000. And for trusts and corporations, it affected them regardless of amounts triggered. Wildly unpopular. There ended up being a lot of delays. I believe it was very early this year, or it might have been very late last year. The government had indicated that they were going to defer those proposals until January of 2026. But then all of those proposals essentially died on the table when Parliament was prorogued. So the latest and greatest information we have was essentially a comment from the new government in May of this year, and they indicated that they did not have any intentions to reintroduce these proposals. So as such, the inclusion rate for capital gains remains at 50% for all individuals, corporations, and trusts. Obviously, stay tuned. The federal budget has just been announced for November 4th of this fall. So we'll see again, but we don't really have any indication from the government that they intend to come back to these proposals at all.
Yeah, it was such a hot topic last year, and I know the tax industry was quite relieved when it was finally confirmed that it was not proceeding. And it's definitely good for everyone to know that the proposals were dropped and to finally have some clarity around this. So, what should investors be thinking about as the year end approaches? I know you mentioned the uncertainty maybe of the pending federal budget, but on the flip side, what should investors be thinking of as year end approaches?
For sure. So, even though we have, like I said, relative certainty that the inclusion rate is not going to change from 50%, capital gains planning is still very essential. So if you've realized capital gains in this year particularly, either from selling a business, maybe selling real estate or a large investment position, you're going to want to look for opportunities to offset those gains to the extent that you can. And one of those most effective ways to do that is tax loss selling. So essentially, if you have investments that are underwater, meaning the cost base is greater than its fair market value, you can sell them before December 31st and realize a capital loss. And that capital loss can be utilized to offset capital gains that have been triggered in this year. The other great part is, let's say maybe you did trigger some capital gains last year, perhaps in anticipation of this proposed inclusion rate change. If you've got an opportunity this year to realize that capital loss, you can actually carry back that capital loss to a prior year and up to actually 3 taxation years. Or if you're proactive, really proactive, and you know that there may be a capital gain that will be triggered in your future, and you have an opportunity to trigger a loss this year, the good part is that capital losses triggered in the year that are not able to be utilized elsewhere can be carried forward indefinitely and utilized to offset future gains. So again, it's one of those things that obviously, hopefully it's something you can utilize right away, but it could be something you could have utilized either in the past or in the future as well.
Yeah, and that comment related to going back, you mentioned 3 years. I think it's probably very important when you're triggering those losses, being tax aware of what gains you did trigger in those last 3 years, because as you said, you you can carry back those capital losses up to 3 years, but not beyond. So every 3 years, that third year falls off the table. So if you know you can trigger losses and have losses in the current year in excess of gains, you may be able to go get that tax that if you don't get it now, it may not be available for recovery later. Is that right?
Exactly.
Awesome. Um, so still staying in the same vein of tax loss selling, I know that you should be careful when selling anything at a loss due to what's called the superficial loss rules. Could you explain these rules to our listeners?
So essentially, if you or an affiliated person buys back the same or identical security within 30 days, either before or after the sale, the capital loss is denied. So it's really important to plan carefully to ensure that you are avoiding triggering that particular rule. These rules do serve a purpose. They are designed to prevent taxpayers from claiming capital losses on securities that they are essentially repurchasing either shortly before or after selling them. So they do serve a purpose, but it is really, really key that we try to avoid triggering that rule.
So you mentioned that it's not only the individual buying back that security, but an affiliated person. Who is an affiliated person?
Great question. So essentially, affiliated person is a spouse, a corporation controlled either by yourself or your spouse, or a trust where you or your spouse are majority interest beneficiaries. So thankfully, it's a pretty short list. It doesn't include adult children or anything like that. So it's a relatively short group of people that you can sort of keep track of.
Great, thanks for clarifying. Now, you did indicate that these superficial loss rules, when they apply, they deny the loss. But is that loss is that loss permanently lost?
No, thankfully not. So essentially, what happens is the loss is actually added to the adjusted cost base of the repurchased security. And that when that security is ultimately sold to a non-affiliated person, that loss will be effectively realized at that point. And the way it's realized is that because it's increased your cost base, it's going to essentially decrease the capital gain in the future.
Okay, so what if you sold the security in one portfolio, then turned around and bought it at another institution? Would these rules apply to those securities as well?
Yes, it does. And that's why it's really, really important that if you do have securities, similar to securities amongst different advisors, that you really do let them know if you've undertaken planning in one portfolio, because it definitely affects the other portfolio. Another way that you can be affected, perhaps inadvertently, if you are someone who does pre-authorized contributions monthly, what we know as a PAC, and that PAC is scheduled to buy that same security again in the next month. If you're working with your own advisor and the advisor has worked with you to claim the losses, they're likely going to stop that PAC for a month to make sure that these rules don't apply. But if you have a PAC with another advisor who has, again, that same security in their portfolio, they may not know. So you need to make sure that you're communicating with them as well. So be very aware of what's in your portfolios, what's going to be triggered, and really communicate with your advisors.
So I think the moral of the story is probably talk to your advisor before you trigger any losses to make sure you don't trip up and inadvertently make that loss a superficial loss rule of some kind. So let's shift gears now and talk about families, and in particular, where one or more family members are living with a disability. What should our listeners be thinking about before year end in that context?
There's definitely several things to consider. I'd say let's start with the disability tax credit. It leads to everything. So this credit has actually been expanded in recent years to cover more conditions, particularly those associated with mental health, but even other ones that have been, traditionally there, like type 1 diabetes. The criteria to be eligible has actually lessened over the past couple of years, and now essentially just simply having the condition is going to be sufficient for eligibility. So it's really important to if you do have a diagnosis that you think may be eligible, really, really key to review whether or not you may be eligible under the what I would refer to as a little bit of a a more inclusive program. But essentially, what the disability tax credit does is it allows you to be assisted with financial costs of having a severe or prolonged impairment. And those costs could be medical costs or support costs. You do have to apply, to the CRA to have the credit applicable for you. It's a bit of paperwork. Your doctor needs to certify certain sections of the application. But when that application is successful, you do then have the credit available to you to claim on your tax return. The other great part is that if it's a pre-existing condition that you've had for several years, you can actually claim the DTC retroactively for up to almost 10 years. And that can really result in significant retroactive refunds. And the other great part is that recently, CRA has begun to automatically reassess all those tax years that have been affected. Back in the day, individuals would have to send their own amendments in to try to claim DTC for the prior years. Now it's automatic. So it's really becoming a more streamlined opportunity for folks. The other thing too, like once you have the DTC eligibility, it opens doors for other benefits. So things I think about is the Canada Workers Benefit Disability Supplement, the Child Canada Disability Benefit, which is a supplement to the Child Canada Benefit, as well as the Registered Disability Savings Plan.
I'm really happy that you mentioned the RDSP. Let's discuss them a bit more. What can you tell me about RDSPs that you believe would be important to our listeners?
Absolutely. So, it's a really powerful long-term savings vehicle. Essentially, to open it, you need to be the beneficiary needs to be under the age of 60 and has to be eligible for the DTC when the plan is set up.
Yeah, that's pretty straightforward. What about contributions?
So there's no annual limit, unlike an RSP or TFSA that we're kind of used to. But there is a maximum lifetime contribution amount of $200,000 per beneficiary. Those contributions are not tax deductible, but anyone can contribute to the plan with written consent from the plan holder. And those contributions can be made up until the end of the year the beneficiary turns 59.
And are there any government incentives?
Yeah, so similar to, an RESP and things like that, there definitely are grants and bonds that are available. So the federal government can add up to $70,000 in grants and up to $20,000 in bonds. These are income tested, so these are the maximums. But they are available until the end of the year the beneficiary turns 49. So proactiveness is really, really key there.
Okay, and there are obviously a whole set of rules that apply. So I can only assume that there are deadlines to either make the contribution or get these government incentives.
Exactly. So contributions must be made by December 31st in order to receive the grant for the current year. But if you are behind, let's say you're just setting up your RDSP now and you've been eligible for the DTC in the past, you are able to catch up on unused entitlements for the past 10 years. There's a limit to how much you can catch up in any given year. So it may take a few years to get fully caught up on the grants that you're eligible for.
Okay, that's great. So that's the focus on today. So what are the rules to make an RDSP contribution today? If you're thinking about the future, you set it up. Are there any estate planning considerations you may want to consider if you have a disabled family member?
Absolutely. So, there are certain trust planning opportunities that you could undertake in your will that really allows for a disabled individual to have what we would refer to as indirect access to an inheritance, but still be able and eligible for certain government assistance. So it's really, really key to work with a qualified estate lawyer to ensure that your will is done properly so you can continue to help these individuals once you're no longer able to.
I have to agree. And actually, I would expand that to say that the rules surrounding the RDSPs, as you explain them, appear to be quite complex. And that working with a financial advisor could probably really pay off if you have any intention of opening up an RDSP, or even if you have a disabled family member, just to make sure that you're getting all the benefits that may be available to you. So
Absolutely.
so let's switch gears again a bit and move on to another popular topic that comes up a lot in client conversations this time of year, and I'm thinking namely of income splitting. So let's start with the basics. What exactly is income splitting?
Great question. So essentially, it's a tax strategy where a higher income spouse shifts some of their income to a lower income spouse with the goal of simply reducing your household's overall tax burden. And so that's a key aspect there.
Yeah, that just sounds too easy and too good to be true, because simply shifting income to a family member in a low bracket sounds like a great tax planning strategy. But I'm assuming there must be rules. So let's just start with, so is this something that any couple can do?
So not quite. So
Yeah,
I
okay,
would
I thought
say,
so.
yeah. So I would say the most common and definitely the most straightforward version is pension income splitting. So if you're 65 years or older and receiving eligible pension income, you can split up to 50% of that income with your spouse or common law partner. And again, the idea of it is to try to get the income a little bit more even amongst the individuals, so that you're lowering your combined taxes as a family unit.
Okay, that's great for older individuals. What about younger couples?
So yeah, that's definitely where things get a little bit more tricky. So I'd say, for non-retired couples, the things that we typically look to are spousal RRSPs or even perhaps spousal loans. So I'll start with the spousal RRSP. So essentially, the strategy there is the higher income spouse contributes to an RSP in the name of the lower income spouse. And really the idea there is that in much later years, when those RSPs are utilized to create retirement income, that lower income spouse is able to report that as income, and they're not going to be subject to a 50% limit there. It's just fully their income to report. But today, when that spousal RSP contribution has been made, that higher income earner is going to get that immediate benefit of the RSP deduction on their tax return. So you get sort of two benefits in one. Uh, with respect to spousal loans, it's a lot more complex. That's essentially lending money from the higher income spouse to the lower income spouse with the purposes of investments. But the higher income spouse who is lending the money must charge interest on that loan at CRA's prescribed rate that's applicable at the time that loan has been issued. And the purpose of that is to avoid attribution, meaning the income on the investment account continue to be reported just by the lower income spouse rather than attribute back to the higher income spouse.
Yeah, I'm a little intrigued by this spousal loan strategy now. It sounds like there are some rules to watch out for.
Yes, exactly. So it's definitely not for the faint of heart. There's a lot of due diligence associated with it. So essentially, that interest I talked about has to be paid on the loan before January 30th of each and every year that the loan is remaining outstanding. If that interest is not paid, the strategy is null and void, and the income attributes back to the higher income spouse. And it really can't or shouldn't be a paper entry either. I'm just going to use old-fashioned terms here. A check should really be cut and cashed by the parties to really sort of solidify that interest has been paid. I would also say I find the strategy can be hard to manage in later years. When that lower income spouse is eventually starting to encroach on capital that they have in the investment, they're encroaching it, let's say, for cash flow for retirement years. It's really key that they would have to be mindful that they would have to first repay the loan to the higher income spouse. So when they remove the funds from the investment account, they should repay the loan to the extent that they've taken to the higher income spouse. That higher income spouse would reduce the amount payable or owing back to them, and then they could use the funds to, pay for household expenses. I know it seems like a lot of paperwork, but essentially it's really needed, because if you fail to do that, what will happen is the interest deduction is going to start to decline as that investment starts to be withdrawn, but the interest owing on the loan is still outstanding. So we have a really disconnect there. So a strategy that seems simple, but actually can be a little bit complex in actuality.
Yeah, fair warning. I think proceed with caution. Great strategy. Just make sure you stay on top of it from day one. And again, an example where someone may be a financial advisor, or certainly talking to your spouse before you even touch anything related to the spousal loan strategy is great. To do. Now, should individuals consider a spousal loan strategy today?
I'd say probably not. This current interest rate environment doesn't really result in a lot of savings. I typically will only talk about the strategy when the prescribed rate of interest is 2% or lower.
Right. And the rate's a little higher than 2% currently, correct?
Exactly. Yeah.
Okay. Yeah. So just stay on top of that, and see when if you're in the right situation and when the timing may be right, if you are someone who would be a candidate for that strategy. Any income splitting concerns maybe for listeners who may be business owners?
Yeah, you know what? It's not quite new anymore, but I still always remind folks the tax on split income rules that were introduced in 2018, they are strict. They do include adults. So whenever we're looking to, let's say if we have an incorporated business owner, if we're looking to pay dividends to a spouse or to adult children, if they don't meet an exception to the TOSI rules, the top marginal tax rate is going to apply to that income, causing significant tax. So whenever we're looking to split income with individuals, through a business, it's really, really important to get professional advice.
Yeah, that's great advice. Before we move on, any final tips for couples thinking about income splitting before this coming year end?
Yeah, I would say definitely plan early. If we hark back to that RSP conversation about, do I contribute to my own RSP or to a spousal RSP? That's going to be something you're going to definitely want to work with a financial planner to determine which option would be beneficial to your financial plan.
Great. Now we've talked about a whole pile of different things. Maybe are there any other year-end tax planning tips you want to explore in our last few minutes here together?
Yeah, again, another option that's relatively new, but maybe perhaps not as widely known, it's the first home savings account. So this allows Canadian residents who are 18 years or older who are hoping to be a first-time home buyer. You can contribute up to $8,000 per year to this account with a lifetime maximum of $40,000. Kind of interesting aspects, contributions to this type of account are tax deductible. So that's very similar to an RSP. But in a realm of close analogy to a TFSA, the investment within this account is tax-free, and qualifying withdrawals from this account for the purposes of buying your first home are also tax-free. So it has elements of both programs. But what's very different of this program is when we think about an RSP or a TFSA, those contribution rooms will automatically accumulate when the parameters are in place. Whereas the FHSA, you do have the ability to have unused contribution room carry forward, but only after the account is opened. And so, when you're thinking about this would be something I'd want to consider before year end is, maybe I'm not ready to contribute yet or fully contribute, but if I can open the account, I start to accumulate that room. So I think that's something I would really put mind to matter to with respect to year end planning.
Awesome. So Sheryl, let's wrap up, and hopefully you can give me some, as we near year end, like some key dates that should be considered as important by everyone who's listening to us.
Absolutely. So obviously, the main one is December 31st. It's the main deadline for most of the strategies we've been talking about. So charitable donations, tax loss selling, RDSP contributions, income splitting strategies, and as well as I just mentioned, the contributions to the FHSA. The second date that we're always mindful of is March 2nd, 2026. That's our deadline for RSP contributions that could be applicable for the 2025 tax year. And then I would say the last thing we want to be mindful of is tax slips. So these are sort of the things that we'll be looking for in the new year. So T4 and T5 slips should be mailed or sent out to individuals by February 28th. T3 slips from trusts like mutual funds are mailed or sent out by March 31st. And it's really, really important to take note of the slips that you may have received last year. They can be a great indication of slips that you might be missing this year. And it's really important to not miss your slips because if you do miss slips, CRA can assess penalties. So being mindful of that is really, really key, and working with your advisor to make sure you have all your slips is a great way to avoid having those penalties apply. And then finally, I'm always going to say, I recommend that our clients work with their advisors to review the IG Wealth Management year-end tax planning checklist. It's a great way to stay organized, and it really ensures that nothing slips through the cracks.
Sheryl, this has been incredibly insightful. Thank you for breaking it down for all of us.
My pleasure. Thank you so much for having me.
Thank you for tuning in. And remember, tax planning is a year-round activity. So we recommend that you talk to your IG advisor to ensure that your tax plan is always top of mind.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purpose, and IG Wealth Management is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from expressed herein. Our views are subject to change based on market conditions. Commissions, fees, and expenses may be associated with mutual fund investments. Read the prospectus before investing. Mutual funds are not guaranteed, values change frequently, and past performance may not be repeated.